Every so often, something comes along that really shakes things up in the world of finance. Well, that's what's happening right now. It's called IFRS 18, and it's set to completely change how companies talk about their performance. We're going to break down what it is, why it's a big deal, and what it means for, well, pretty much anyone who ever looks at a financial report.
Think about it like this. Imagine you're trying to figure out which of two rowing teams is faster. Sounds easy, right? But what if one team's using a totally different kind of boat, or a completely different rowing technique? That's kind of what investors have been dealing with for years. They're trying to compare companies, but not everyone's been rowing the same way.
And that really gets to the heart of the problem, doesn't it? How can you actually compare them if they're all playing by slightly different rules? When one company says operating profit and another company says operating profit, you'd think they mean the same thing. But the truth is, up until now, that hasn't always been the case. And that makes a real apples-to-apples comparison almost impossible.
So let's dive into our first section, what we're calling the comparability problem. See, the old accounting standard, IAS 1, it gave companies a lot of wiggle room in how they presented their numbers. And while flexibility can sound like a good thing, what it really created was a messy, inconsistent landscape that investors have been begging to have cleaned up for years.
So under the old way, companies could basically invent their own subtotals, which just led to a lot of confusion. And all those adjusted profit numbers you hear about in the news, it was often really hard to figure out how they got to that number. IFRS 18 changes all of that. It brings in standardized subtotals and forces companies to be transparent about those custom metrics. It's a whole new level of clarity.
So what's the solution? Well, it's a brand new, unified rulebook. Let's get to know IFRS 18. The whole point is to create a common language for financial performance, making sure that when you look at a company's results, you're getting a picture that's way more consistent and, most importantly, comparable.
And look, this isn't just some accountants in a back room making up rules for fun. This whole thing, which actually started way back in 2014, was driven by one group, investors. They demanded better, clearer information so they could make smarter decisions.
So, how does IFRS 18 actually do all this? Well, it all boils down to two major, game-changing new requirements. Let's get into them.
All right, first up, and this is a big one, a complete redesign of the profit and loss statement, or what a lot of us just call the income statement. We're talking about creating a standardized scorecard that every single company has to use.
And the core idea here is actually really simple. A new, mandatory structure for how performance is reported. No more trying to figure out where a company decided to put a certain expense or chunk of income.
From now on, every company is going to have to sort all their income and expenses into one of three new buckets: operating, investing, and financing. Now, you add in the categories that were already there for taxes and discontinued operations. That's just parts of a business that have been sold off. And you've got the new mandatory framework.
And this right here, this is probably the single biggest change of all. For the very first time, operating profit is going to be a required, clearly defined number. It's the default category. Basically, if an income or expense isn't related to investing or financing, it goes here. This is huge because it means operating profit will finally mean the same thing no matter whose report you're looking at.
Okay, so let's break this down. This table gives you a super simple look at how this new flow works. You can see how all the normal business stuff, sales, R&D, admin costs, it all lands in the operating category. That leads to that all-important operating profit subtotal. Then you add in things like returns from investments, and you subtract costs like interest on loans. It's logical, it's structured, and pretty soon it's going to be everywhere. Okay, so that was change number one. But change number two, this one tackles something you've probably seen a million times, those custom, quote-unquote, adjusted numbers that companies love to highlight. This is especially a big deal in sectors like tech, where companies often create their own metrics to, let's say, paint a more favorable picture of how they're doing.
So IFRS 18 comes along and gives these things an official name: Management Defined Performance Measures, or MPMs for short. All an MPM is a subtotal of income and expenses that isn't one of the official ones, but one that management uses to tell their version of the performance story. You've probably heard other terms for this, like non-GAAP or alternative performance measures.
And I guarantee you've seen these. We're talking about things like adjusted profit or adjusted EBITDA. Now, these numbers can be useful sometimes, but the problem has always been that it's tough to know exactly what's been added or taken out to get to that number. Now, what's really interesting is that IFRS 18 doesn't actually ban these custom numbers. Instead, it says, fine, you can use them, but you have to be totally transparent about it. There are 3 new rules. 1, you have to put it in a specific note, right there in the official financial statements. 2, you got to show the math and explain why you think it's a helpful metric. And 3, this is the real kicker, you have to show a reconciliation, like a bridge, that walks you step by step from your custom number back to the closest official IFRS number. No more hiding the details.
So, let's recap. We've got a new, structured P&L statement, and we have new rules forcing transparency around these custom metrics. So the big question is, what happens now, and when does all this kick in?
And believe me, this has been in the works for a long time. This whole project started a decade ago, back in 2014. The final rules were just published in April of 2024, but companies get some time to get ready. The new standard becomes mandatory for any reporting year that starts on or after January 1st, 2027.
So if you remember just 2 words from all of this, let it be these: comparability and transparency. That's the whole point. IFRS 18 is designed to dramatically boost our ability to compare companies and to bring some much-needed transparency to how they report their performance. Those are the 2 pillars holding this whole thing up.
And that really leaves us with a final question to think about. For the first time, we're going to be able to easily see the math behind all those adjusted profit numbers and compare companies on a truly level playing field. So the real question is, once this new, clear language of performance becomes the standard, is it going to change how you see your favorite companies?